Look at this graph. It's an index fund that tracks the top 500 companies in the US. These companies are grouped together into an index called the S&P 500. We can see the same index fund in Brazil, Germany, France, Australia, and the UK. Many people invest into the S&P 500 because that's what they've been told to do all the time. For the last 6 years, I've been told invest into the S&P 500. I've read in books to invest into the S&P 500. And my favorite investor, Warren Buffett, recommends to
buy an S&P 500 low-cost index fund.
But I have this ever-present feeling that I'm blindly following the crowd and not truly investing, but rather participating in the greatest paradox of finance. I want to take you with me on a journey to find answers. Is the S&P 500 intrinsically the best investment? Does it go up perhaps because millions of retirement accounts have automatic buy orders for these assets? And should we start breaking this never-ending cycle?
S&P 500
is to invest every month on a long-range basis.
For the S&P 500.
You gotta do it, man.
It's paradoxical, and yet it works.
The S&P 500 index is a great representation of the US stock market. Many people believe it's extremely difficult to beat the market. And thus, if you're a rational investor, you should just invest in the S&P 500. You will have 1. Diversification, a magic word that means you don't have all your eggs in one basket. 2. You're investing in the most powerful and richest companies in the world. 3. You are betting on the strongest and most powerful economy in the world. And 4. You don't need to be a hedge fund manager or pay somebody to invest into this great option. Warren Buffett even made a bet with hedge fund managers that they wouldn't outperform the S&P 500 in the long run. In his 2017 annual shareholder letter, he shows the results of his bet, where the S&P 500 gained 125%, while the other 5 hedge funds gained from 2.8% to 87.7% in 10 years. It seems that the S&P 500 is truly the best investment out there. If powerful and well-connected individuals like hedge fund managers are not able to beat the market, even with all the resources and talent, then what can we expect for us, regular people? Well, we are forgetting many variables that have appeared in the last 50 years. For example, the democratization of finance. Stock markets have developed, poor countries got richer, and many people are investing now more than ever. And not only American, but young professionals around the world want to invest in the S&P 500 to reap the fruits of a great investment by retirement. In 1980, there were $25 billion in IRAs, and now in 2025, we have about $42 trillion in total retirement assets. This phenomenon is not exclusive to the US. If we look at how developing countries have grown in terms of GDP per capita, we can see that millions of people are not only coming out of poverty, but starting to invest for retirement with a growing middle class. I am not implying any causation, but there is a degree of relationship between these variables. There is more money, more investors, and more demand for the market index of the greatest economy in the world. And with more demand, well, the price will naturally rise, which will increase returns and attract even more investors. How much of the S&P 500 latest return can we attribute to this nature of net positive inflows of money going into the United States from young professionals that are contributing to their retirement accounts, and also people from around the world that want to invest their money in the most powerful economy? The S&P 500 is not only a paradox on the grounds of people blindly investing into it each month, but also in the nature of its value and composition. The index was trading back in 1980 at a PE ratio of 7.39, and now in January of 2025, it was trading at a PE ratio of 30. This is just fancy talk to tell you that it will take 30 years to have your money back from the real earnings of your investment. Not only that, but the index is heavily concentrated into a couple of sectors and companies. These 5 men are the CEOs of 25% of your entire portfolio. Yes, 1% of the companies will impact 25% of the entire portfolio. These 5 companies are from one sector alone, tech. And these companies are trading also at 30 times their earnings after a huge market downturn. So you can imagine this figure was way bigger before the tariffs began scaring the markets. And yeah, we may assume that they are trading at that price because investors are weighing in the amazing future they hold. Well, we can bring point one back and think, is it truly a rational investor sentiment on the future of these companies? Or is it an algorithm buying each month only because they happen to be in the top 500 US firms? Also, have you seen any major breakthroughs from these companies? Tech is fueled by innovation, and the only innovation we've seen is AI. We all know it has its uses, but it's far from revolutionary, at least what they are selling right now. I mean, Apple Intelligence is not there, Facebook is under trial for monopolistic behaviors by the FTC, and Tesla, well, yeah, let's not get into politics. But Warren Buffett argues that investing in the S&P 500 is like betting on the future of America. If you want to pick one country to invest, wouldn't you pick the most powerful and greatest economy in the world? The one that has the most developed stock market with the greatest companies in the planet? I would, but is the US really the strongest economy in the world? Short answer, yes. The US has still the greatest economy measured by GDP and the greatest stock market measured by total capitalization. The question we need to raise is, will the US keep being the most powerful and most attractive country to park your money in the coming years? Well, they have $35.46 trillion of debt. This means that people from the US and around the world own claims to the government future revenue. Not only that, but the US is now spending more on interest than what they are spending on defense. This has been a sign throughout history of a decline in power and influence. Add that up with the latest trade policies from the US, and you get a foggy picture of a possible change in the world order. So let me ask you, what do you think? Should we break the cycle and invest in something else? A European index, a Chinese index, or maybe even invest in developing countries like Brazil, India, or South Africa? No. This is why the S&P 500 is a paradox. It's for now the best investment out there, even though it doesn't feel like it. The EU has lagged in tech for decades. The Chinese couldn't care less about the stock market because they raise capital in other ways, and they don't have the same profit maximization culture like the Western world. And developing countries like Brazil, well, they have a fiscal ticking bomb ready to explode. It is an interesting and sometimes discouraging paradox. Your best investment doesn't feel to be the best, it doesn't look promising in the next 50 years, and you don't have a clear picture of who will be the next top competitor. My advice is to not invest blindly into the S&P 500. Warren Buffett is a firm believer in the potential, performance, and capability of the US. Well, they have achieved unimaginable things in their 200-year history, and maybe they will be able to do a 180 on their current path. Warren Buffett analyzes his investments fundamentally. If he would invest blindly, he wouldn't be sitting in $300 billion of cash ready to allocate to any good opportunity that comes by. Even if you have nothing to do with finance and you don't really want to stress too much about it. I think we should all learn about finance as we all learn our own language. English, Spanish, or German are languages that we use to communicate with each other. And finance is the language that businesses use to communicate with us. You don't need to dedicate hours to analyze your investments. Learn about the fundamentals of the companies you own, at least the top 5 we mentioned today. You don't need high-fee hedge funds to achieve great returns, nor expensive financial advisors to understand the simple nature of investments. This paradox will only increase if we let our irrationality take over. I want you to take a peek at this. You have the power to decide if you want to throw your own dice or let other people play the game for you. See you in the next one. Ciao, ciao.